right, welcome to Iron Financial. This is the only place where we forge stronger portfolios by putting companies through a true stress test, right down to their structural steel. Today, Alvotech, ticker ALVO, is on the anvil. And look, this is a company with a story that is being pulled in two completely opposite directions. We're here to hammer out the truth. Let's get into it.
So on one hand, you've got the raw numbers, the cold hard facts. The company just posted a massive 21% year-over-year jump in revenue. I mean, the top line is expanding, the growth engine is absolutely firing on all cylinders. But then, you look at the tape, and the stock is getting hammered, just completely crushed, sinking way below its 50-day moving average. It is trading like the entire foundation is about to crack and give way. So this is the central conflict, right? The numbers are screaming build, but the market is screaming demolish. What is the real blueprint here? Exactly. And this is the kind of disconnect that makes me nervous. I mean, seriously nervous. When the financials look this solid on the surface, but the stock is behaving like there's a fatal flaw, well, that usually means the market sees a crack that the headline numbers are just papering over. So my question is this: is this a solid steel structure built to last for the long haul, or is it just a facade? Is it poised to just collapse under the slightest bit of pressure? I mean, are we missing something totally obvious here? That really is the billion-dollar question, isn't it? And it's precisely why we're not just doing some casual review today. No, we are conducting a full-blown stress test. We are going to inspect every single weld on this thing. We are going to check every support beam, and we're going to analyze the very bedrock this company is built on. Our job, our entire mission today, is to figure out if Alvotech has the structural integrity to withstand this immense pressure, or if the market's deep-seated fears are totally justified.
Okay, so here's our plan of attack for today. First, we're going to lay out the parameters of our stress test. Then, we will get into the raw power of their growth engine. You know, the top-line numbers that look so impressive. After that, we are going to take a very hard look at the cracks in the foundation, the critical issues that have the market so spooked. From there, we'll dive into their capital structure blueprint to see if they've got the resources to survive what could be a prolonged fight. Then we'll look at their 2026 outlook and what it really tells us. And finally, we will deliver our verdict. Is Alvotech an opportunity to buy some hardened steel at a discount, or is it just a trap waiting to spring? All right, Section 1, the Alvotech stress test. You know, here at Iron Financial, we don't trade on feelings, we don't trade on hype, we trade on fundamentals, on data, on the verifiable strength of a company's architecture. So our entire goal here is to separate the cold, hard steel of Alvotech's actual business from, well, the pervasive rust of negative market sentiment. Yeah, but you can't just ignore that sentiment, right? It's a powerful force, and right now, it is overwhelmingly negative. I mean, as Big Jit News put it back on March 18th, the prevailing view on Wall Street is that Alvotech's entire narrative has faltered, that the story is fundamentally broken. You have to understand, investors are pricing this thing for absolute failure, and we need to dig in and figure out exactly why.
I get it. But before we inspect the cracks, we have to acknowledge the furnace that's powering this whole operation. And that brings us right to Section 2, forging the growth engine. We're going to look at the raw, undeniable power being generated by this company's top line. Because whatever the market is afraid of, it cannot deny the financial horsepower that is on display right here.
So let's just start with the big one. For the full year 2025, Alvotech brought in $593 million in total revenue. Now, this isn't some pie-in-the-sky projection, it's a hard number. It's already in the books. That is a fortified top line, and it is the absolute core of any bull thesis for this company. It proves this isn't some pre-revenue biotech with a hopeful story. No, this is a major commercial operation generating significant cash flow right now.
And here's what's really interesting when you look at it this way. The trajectory. That $593 million figure, well, it represents a 21% year-over-year growth rate. This is not a company that's just treading water. It is expanding at a really rapid clip. In an economic environment where, let's be honest, growth is scarce and expensive, a 21% expansion is a massive steel beam supporting the entire bull case. This kind of momentum is hard to fake, and for an investor who cares about fundamentals, it's even harder to ignore.
And let's drill down even further here. The fourth quarter was particularly strong. They came in at $173 million in revenue. That's a 13% jump year over year, and a really solid beat on analyst expectations, which, by the way, were hovering around $162 million. But look closer at the operational leverage. They posted an Adjusted EBITDA of $69 million in the quarter, with a gross margin of 66%. Wow. That is incredibly efficient. It shows that as their revenue scales up, profitability is scaling up even faster. For the full year, Adjusted EBITDA was up 27%. This isn't just growth. This is high-quality, profitable growth. Okay, the numbers are strong, I will give you that. An operation of that size throwing off 66% gross margins is, well, it's impressive from a purely financial standpoint. But my question is, where is this growth actually coming from? If the story in the US is as broken as the market seems to think it is, then this revenue engine must be running almost entirely on international fuel. Is that sustainable? Can they really keep this momentum going if the biggest, most profitable healthcare market in the entire world remains locked out?
That is a fair question, and the answer is laid out perfectly right here, which I think illustrates the global machine that they've built. While the US market is facing these major headwinds, you have to realize Alvotech has been executing pretty much flawlessly everywhere else. Their second biosimilar, Selarsdi, actually did launch in the US with their partner Teva. They secured approval for AVTO5 in the UK and across Europe. AVTO3 also got approved in Europe, and 3 other biosimilars got the green light in multiple markets, including the very lucrative Japanese market. They now have commercial reach into 90 countries. So look, this is not a one-trick pony that's completely dependent on the US market. It's a diversified, global biosimilar powerhouse. The growth is real, and it is coming from a broad international base.
All right, but let's talk about those headwinds, because from where I'm sitting, they feel less like headwinds and more like a Category 5 hurricane. So, Section 3, Inspecting the Foundation's Cracks. You've laid out the bull case, and yeah, it's built on a foundation of strong global growth, but the market isn't buying it, not at all. The price action tells us that investors believe there is a fatal flaw in this company's structure, something so significant that it just completely overshadows all of that international success. So let's get out the magnifying glass and inspect these cracks up close.
Let's just come back to this quote from BitGet News because it frames the problem so perfectly. The prevailing market view is that Alvotech's story is broken. Why? Why would the market just ignore 21% revenue growth, 66% gross margins, and a whole string of major approvals across Europe and Asia? There has to be a reason, and you know it's got to be a big one. Oh, there's a reason, and it can be summed up in 3 simple letters: FDA.
Exactly, the FDA, and specifically the dreaded Complete Response Letter, or CRL. Now, for anybody watching, it is critical to understand what this really is. A CRL is not an outright final no. It's the FDA saying, hey, your application has deficiencies, and we can't approve it in its current form. In market terms, it's a massive roadblock. It just slams the brakes on the entire approval process, injects a huge amount of uncertainty into the timeline, and it triggers significant and very costly delays. For a company banking on US market entry, it's a total body blow. And to be very specific, the CRLs that Alvotech received for its biosimilars AVTO5 and AVTO6, and the one they now anticipate for AVTO3, they all stem from one root cause: regulatory observations and deficiencies that were identified during an FDA inspection of their main manufacturing facility in Reykjavik, Iceland. So this isn't a problem with the drugs themselves, it's a problem with the factory that makes the drugs. The crucial point here is that the very heart of their manufacturing operation has been red flagged by the most important regulator in the world. And this timeline, it lays out the damage in really stark terms. The inspection happened in 2025, which led to the CRLs for 2 key products. Now, the company itself is assuming they'll get another one for AVTO3. Sure, they say they've implemented a comprehensive improvement program, and they expect to resubmit their applications in the second quarter of 2026. But what does that really mean for investors? It means the clock on potential US revenue has been completely reset. Best case scenario, they're looking at late 2026 for any potential approval, and that's only if everything goes perfectly this time around. This just creates a massive dark cloud hanging right over the stock.
And this, right here, this is the market's verdict, rendered in cold, hard numbers. As of March 18th, the stock is sitting at $3.80. Its 200-day moving average, a really key long-term trend indicator, is way up there at $6.93. The stock is trading at nearly half of its long-term average. Look, this isn't a minor dip. This is a catastrophic collapse in investor confidence. The market is pricing in a very high probability that Alvotech will fail to resolve these FDA issues in a timely manner, if they resolve them at all. This is the crack in the foundation that has investors running for the exits.
Okay, so the core problem is crystal clear: a major regulatory roadblock in the US market. The next logical question then is, can they afford the delay? Can they fund the fight to fix these manufacturing issues while simultaneously fueling their ongoing global growth? That brings us to Section 4, the Capital Structure Blueprint. Let's really examine the company's financial foundation and see if it's built to withstand this kind of storm.
At the end of 2025, Alvotech had $172 million in cash on its balance sheet. You know what? That's a solid war chest. It's a respectable cushion that gives them breathing room to operate, to invest, and to work through these regulatory challenges without being backed into some kind of financial corner. This is not a company that's on the brink of insolvency. This is their first line of defense.
And they haven't just been sitting idle. Management has been proactively shoring up that foundation. During 2025, they went out and raised close to $300 million from the capital markets. They listed their shares on the NASDAQ Stockholm exchange to tap into a broader pool of European investors. Then in December, they launched another $100 million convertible bond offering. And listen, this isn't just about survival. It's about strategic investment. They've earmarked around $250 million for R&D in 2026 alone. This is a management team that is building for the long term, fortifying their balance sheet while aggressively funding their pipeline of 30 different products. I see it a little differently. Raising over $400 million through equity and convertible debt, is that really a sign of strength and proactive investment? Or is it a sign of a company that knows it's facing a long, expensive winter? To me, this looks less like a strategic war chest and more like a bucket brigade trying to keep the ship from sinking. Convertible bonds come with a coupon rate, and they come with future dilution. This heavy fundraising could be seen as a necessary, almost desperate move to survive what could be a multi-year delay in accessing the US market. It plugs the hole for now, sure, but it also adds significant weight and complexity to the capital structure.
That's a fair point. The cost of capital always matters. But let's see what management expects to build with that capital by looking at their forward guidance. So that brings us to Section 5, the 2026 outlook. We're going to break down management's official forecast and see how that massive U.S. variable really impacts their projections.
Now, on the surface, this guidance looks incredibly strong. Management is projecting 2026 revenue in a range of $650 to $700 million. At the midpoint, that represents continued solid double-digit sales growth. They also expect their Adjusted EBITDA to expand significantly to somewhere between $180 and $220 million. This guidance paints a picture of a company that expects its global growth engine to just keep firing on all cylinders, FDA issues or not. Yeah, it does look good on the surface. But with any construction blueprint, the devil is always in the fine print. And when you read the fine print on this guidance, a massive red flag just pops right out. The strength you think you see is entirely dependent on which end of that range you focus on, and the assumptions behind each of those numbers are worlds apart.
And this slide right here decodes it all for us. The high end of their guidance, that $700 million figure, it assumes they successfully resolve their FDA issues and get some minimal revenue from US launches late in the year. But look at the low end. That $650 million number, which they call their conservative view, is built on the assumption of zero revenue from any new US launches in all of 2026. Management's own base case completely writes off the entire US market for the year. This isn't my interpretation, this is their math. This is not just a small crack anymore, this is a gaping hole in their most important future market, and it is baked right into their own forecast.
So the battle lines here are clearly drawn. You have a powerful, profitable global business that's being weighed down by a critical failure in a single, albeit vital, market. This brings us to our final section, the verdict. Is this an opportunity to buy a structurally sound company that's just hit a temporary fixable snag? Or is it a trap, where the foundation is just fundamentally compromised? Let's weigh the final evidence. Let's start with the bull case, the structural strengths over on the left side of this slide. You have undeniable, powerful revenue growth of over 20%. You've got a proven track record of execution with a wave of approvals in Europe, the UK, and Japan. Their 2026 guidance, even if you just take the low end, projects continued expansion based on that global strength alone. And underpinning all of this is a deep pipeline of 30 biosimilars and a management team that has been proactive in getting the capital they need to fund that development. The global engine is forged from solid steel. That part is not in question. Yeah, but you absolutely cannot ignore the weaknesses on the right, and they are significant. The FDA roadblock is not a minor issue. It is a major structural flaw in their U.S. strategy, which has always been the key pillar for long-term value creation. This directly leads to launch delays and, frankly, crippling revenue uncertainty. The market's reaction is not irrational. The deeply negative sentiment reflects a very real risk. And all this is happening while high R&D spending, which they need for the pipeline, continues to pressure profitability. This isn't some small crack you can just patch over. This is a potential point of catastrophic failure for the entire U.S. thesis. Ultimately, my take is this. The investment thesis for Alvotech now hinges on a single critical variable: your faith in management's ability to execute a turnaround at their Reykjavik facility and satisfy the FDA. Everything else, the global business, the revenue growth, the pipeline, it all appears to be structurally sound. They are forging a business that is already built to last on a global scale. The question is whether they can repair the compromised U.S. pillar before the market skepticism causes a total collapse in the valuation. And my final thought is that while the blueprints look good on paper, the market is currently pricing this stock for demolition, not for renovation. The risk that these FDA issues are not temporary, that they might signal deeper, systemic quality control problems, is very real. If the U.S. market remains locked, that $650 million in ex-U.S. revenue is a solid business, sure, but it may not justify the multi-billion-dollar valuation the market once hoped for. It is a high-stakes bet on a very difficult, very public repair job. And right now, the market is just not willing to take that bet.
So the crucial point is this. Alvotech is clearly building for the future, with a massive pipeline and an expanding global commercial footprint. But the question you, as an investor, have to answer for yourself is whether the foundation they've laid is strong enough to withstand the immense pressure of a U.S. regulatory failure. That is the stress test. Do your own due diligence. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.